Hello. Thank you for coming. This is, you don't live here anymore, the mortgage crisis in you. I wanted to start first off. If you disagree with me, please say so. If you have a comment or a question, please say so. I hate the sound of my nose, so please. But I want to start with a short autobiographical note. I was for about a year, I was a very staunch libertarian. And I thought, is there something about free market philosophy that seems to make sense? People are selfish, they're going to do what's best for them. And if you follow those rules in the economy, then you think it'll be all right. That was around 2008, a huge Ron Paul supporter. And then I watched the economy collapse in all its slow firework fashion. And suddenly the idea of self-regulation caught me as extremely silly. That you're going to trust other people to do what is best 100% of the time. And the other thing that really struck me about it is that it had to do with buying a home, which is such a massive part of the American dream, being in America. And we have such an odd relationship with land that other countries don't. It's a little bit of a I'd like to explore tonight. Again, these are agenda. I have a proposal for you. I want you to buy that box because I just lent $150,000 to someone at a 6% interest rate, and they're going to be putting the money in this box. And why not? Why wouldn't you buy that box? If it's just going to be filling with money and the price of what they bought a house is always going to be going up, then why not buy that box? If it's just going to be consistently filled with money. I even got it rated by a company that rates investments, and they gave it a AAA rating, so you know it's good. The problem with that is when you start lending money to people who are not going to be able to pay it back. When you have things like predatory lending, when you have things like interest rates, or loans without down payments. So you have no method of knowing that they're actually going to be putting the money in that box. That box is essentially a mortgage security. That's what you heard talked about. A mortgage-backed security is essentially somebody buying the idea that somebody else is going to be pouring thousands and thousands of dollars into that box every year. And when that money stops, you can buy an insurance plan on this box. It's called a credit default swap. And the idea is, if the bank cannot fill that box with money and cannot meet your investment, then you have this insurance policy. But what if they can't fulfill the insurance policy? When you buy a health insurance policy and you get in an accident, you pay your premiums very faithfully every month. But you get in an accident, they have to pay it. And they can't just say, oh, well, we don't have the money. But that's exactly what the banks can do and could do. And the reason for that is because health insurance companies have to open up their books pretty much every month to the government. And they have to show their balance sheets and show that they can definitely pay out the money for the people who need it, for the people who've been paying their premiums very faithfully. The 2008 collapse was largely about people taking a very basic idea like a mortgage and turning it into a casino. Turning money into more money, as opposed to actually making things and contributing back to the economy. How many people here own land? Is it paid off? Then do you own it? You own the right to it, but can they take it back? Now, did the bank ever own that house at any point? You just borrowed the money from them to buy the house from RE/MAX or Century 21. puppies, by the way, they're about 30 years old. So do you really own it? I found a lot of comparisons in the mortgage market to feudalism, which is the idea that the crown will give lands called an allodial title to nobles, to people who give them money, to people who give them horses or knights or soldiers. And it's essentially a mortgage payment. They get the land and they pay it off every month. And essentially, if you buy a 30-year mortgage when you're 40, you're essentially buying a car. And when you get an allodial title, if you're a nobleman in feudal England, then you're essentially going to be paying that off for the rest of your life. I want to get back, I'm sorry. I want to get back to the idea of the mortgage market. The idea that people could trade. When your mortgage is securitized, you're almost never let down. Because they don't really see it as any of your business. They're just betting, essentially, on the likelihood that you will continue to put money in this box. And then, I mentioned credit default swaps. You can buy an insurance policy on that box. And then somebody can actually sell that insurance policy. The likelihood that that insurance policy will continue to be paid out. But if you foreclose on your home, if you foreclose on your mortgage, then they actually continue to make money because they can sell off the security because of the insurance policy. One of the great problems with a lot of these mortgages, I mentioned the fact that there were mortgages that had entirely too high an interest rate for the people they were giving them to, had absolutely no down payment, and it was based on the idea that the price of housing is constantly going to go up. And we heard this for 2 or 3 generations, that housing prices were never going to go down, that they were a surefire bet. There's a quote from a humorist named Will Rogers. It says, "The best investment advice you could ever give is buy land because God ain't making any more of it." And the reason prices go up on something is because supply goes above demand, or demand goes above supply. And since there's no more land that's ever going to be made, then it's reliant on essentially overpopulation. And it's reliant on the idea that people are always going to want to be buying houses. But when there's no credit to be buying these houses, and there's no buyers, and the prices have to drop. You can go to Flint, Michigan right now, and they have buy one, get one deals on houses in Flint. The downside is you have to live in Flint. But okay, so you're a buyer. You want to buy a house. You go to the bank, you borrow so much money at, let's say, 5% or 6% interest rate. You have a perfect credit score, there's no problem. They take that box, they allow people to invest in it, allow people to invest in the likelihood that you're going to continue to be pouring money into that box. And these are what are called over-the-counter trades. They aren't watched by the New York Stock Exchange. They aren't watched by financial markets. And that was the major problem I found in 2005, that no one was watching. That there were these, when you listen to interviews with former mortgage lenders and bankers, they always say how much a part of it was the culture. And I find it so similar.